Welcome back to Beyond the Benchmark. I'm Ryan Kasper. Economic data was once again limited this week as the federal government shutdown entered its second month. Still, a few key private reports gave us some insight into the state of the economy, showing modest strength in services and hiring, but continued weakness in manufacturing and consumer sentiment. Let's start with manufacturing. The ISM Manufacturing Index slipped further into contraction territory, coming in at 48.7 for October, the eighth straight month below 50. New orders and employment held up reasonably well, but production softened. Respondents pointed to lingering tariff uncertainty and higher costs as ongoing headwinds. On the other hand, the ISM Services Index surprised to the upside, jumping back into expansion at 52.4. Business activity and new orders both improved, and while employment was just shy of neutral, comments described conditions as steady and strong. Tariffs and the shutdown were still mentioned as sources of disruption, but overall sentiment in the services economy remains far healthier than in manufacturing. The ADP private payroll report also came in stronger than expected, showing an increase of 42,000 jobs for October, a welcome rebound after last month's decline. Gains were led by trade, transportation, and healthcare. However, the Challenger Job Cuts report told a different story, with announced layoffs jumping to the highest level in 5 years, especially in technology, retail, and general services. Some of that reflects the post-pandemic correction in hiring and the early effects of AI-driven restructuring. Consumer sentiment remains deeply challenged. The preliminary University of Michigan index for November dropped over 6% to 50.3, the weakest level since spring. Current conditions fell sharply, while expectations for the future remain subdued. The shutdown itself was cited as a major factor weighing on confidence, along with persistent inflation concerns. Turning to the markets, equities fell broadly last week. The S&P 500 dropped about 1.5%, led lower by technology, where names like Nvidia, Microsoft, and Salesforce gave background after a long rally. Energy, healthcare, and financials were the few sectors in positive territory. Globally, markets mirrored the U.S. weakness, with modest declines across Europe and sharper losses in emerging markets tied to tech-heavy economies like South Korea and Taiwan. Bond markets were essentially flat, with little change in treasury yields and muted trading activity. Floating-rate bank loans slightly outperformed investment-grade debt. Commodities were also quiet, with gold inching higher while industrial metals and crude oil slipped. Oil prices fell around 2%, to just under $60 a barrel as rising inventories offset geopolitical concerns. The bottom line this week, the economy continues to show mixed signals. Services and private hiring remain resilient, while manufacturing and consumer confidence struggle. The ongoing shutdown has muted data flow and sentiment alike, and markets are starting to show the strain. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Stay disciplined, stay informed, and we'll catch you next week.